What's up, everyone? Happy Saturday. So I have had a bunch of people reaching out looking to discuss and explore the recent GameStop earnings, and more specifically within their earnings, we want to take a closer look at the warrants. And it's because, as usual, there's an insane amount of incorrect information floating around. And I don't mean that in terms of like people doing that because they have nefarious intent. It's just usual, right? People are trying to help. People are trying to say things as what they know. And then unfortunately, a lot of it contains stuff that just simply isn't accurate. Now, that being said, I want to be abundantly clear. Thor, stop. And I'm not an expert on warrants. I'm not an expert on these kind of disbursements. So a lot of the stream today is actually going to be us learning alongside one another through source documents. So for those that don't know, this is the unsexy work that goes into being knowledgeable with respect to markets. So what this means is, as we come across different kinds of posts that might say different things, we will earmark what those posts are saying, and then we will go see if we can verify what's there versus taking the post at face value for whatever it is. Because although I fully admit that I'm ignorant on this topic and I am not an expert, that doesn't mean that I don't know anything about it, because I do have some level of experience with this stuff. So let's first start with source documents. So I want to take a look at GameStop's filing here. And we can literally begin from sources. So here is a Form 8K, and let's take a look at a couple things from here. So you can see that this was reported on the 9th of September. All right. So nothing checked there, nothing checked there. Okay. We can see its release. Okay, this is the piece that matters to us. It says on 9 September, they issued a press release announcing the board of directors declared a warrant dividend distribution to the record holders. I want to say recorded. The record holders of the Class A common shares, par value $0.001 per share, in the form of warrants to purchase common stock. The warrants will be distributed on or around 7 October to the record holders of common stock as of the close of business on 3 October, the record date. That's the first thing that we have to talk about, because I have seen a ton of incorrect information literally about that very first starting point, which is, when do you have to hold the underlying in order to qualify? And this is the worst circle I've ever drawn in my life, but this is your answer. The record date is close of business, 3 October. So in this case, you need to own the shares before the close on 3 October in order to rate the warrant. Now, what is the deal with the warrant? Simple. Holders are going to get 1 warrant for every 10 shares. So you have 10 shares, that equals 1 warrant. Rounded down to the nearest whole number. Additionally, in lieu of an adjustment to the applicable conversion rate, holders of the convertible senior notes as of the record date will receive at the same time and on the same terms as holders of the common stock warrants without having to convert the convertible notes. That's a really, really important point. So what this is saying is, it is not just shareholders, but also holders of these notes, and they do not have to convert their notes. If such holder held number of shares common stock equal to the product, the conversion rate applicable, convertible notes in effect on record date, the aggregate principal amount of convertible notes held by such holder on the record date. The expiration date of the warrants is expected to be on or about 30 October 2026. So the way to think about these warrants is they're kind of sort of like a call option. That's more or less the way to think of these. And we'll have an exercise price, just like a call option, of $32 per share. So you can think of that as the strike price is 32. We intend to apply for the warrants to be listed on the NYSE to facilitate trading. That's a very important note, which means that they will trade, which may begin under the ticker symbol GMEWS on the first day of trading following the distribution date. So this will be a tradable security by itself. Cool. So we have the very basis of what this thing is and what the starting point looks like for this. Great. Now, the more interesting part, well, first, before I move on, are there any questions on this? What I want to get into after this is just discussing some of the implications of this. But I want to see if we have any questions on what the warrants are themselves, what their ticker is going to be, where they're going to trade, what the strike price is, what the conversion rate is. You now know all of that from a source document. It's not some "I got you, bro" on Reddit. You know this for fact because this is what's filed. Super important. Again, just because there's a lot of interpreted information floating around that has a lot of inconsistencies against what this thing actually is, which is super important for you to be aware of. All right. I'm not seeing any questions flowing in yet. Feel free to throw them in whenever you would like. If there is something that we cover, I figured most of you would be pretty comfortable with this. Bull says, I wonder if they can be sold short. Not necessarily. So that actually leads to a post that I came across that's actually incorrect. This one. So I've had a bunch of people tag me in different kinds of posts with different sorts of information. And unfortunately, there's a couple things that we have to know. The first thing is the obligation of the warrants is a little trickier than I think people take in terms of the overall position. So this person, again, I don't know this person from a hole in the wall, but this person says, in case you're wondering why, I think they're talking about like why this is a big deal. GameStop's warrant dividend pressures short sellers by obligating them to deliver the warrants to the lenders of borrowed shares. So this in and of itself is something that we have to look at together, because I'm not sure that this is the case. And when I say that, I actively think it is not the case. But I also want to confirm my own assumption. This is a common misunderstanding. And the reason why it's a common misunderstanding is what shorts are obligated to do or not to do. They're not obligated, in my understanding, with the way that this was filed, to the warrant side of that equation at all. But we will see. The reason for this, by the way, is at least this is how I postulate the reason. And again, I might be wrong. Well, we will confirm it, but this is my hypothesis, is that if we have a broker and we have a person, so let's say that this is the holder. We have the holder here. The holder typically is going to hold through a broker. This broker is holding tons and tons of shares on the behalf of people. in reality, these people technically don't even directly own the shares. They just own the rights to the shares through a broker. Okay. Now, this broker then gives the holder the choice. Do you want to allow short selling? And the holder is compensated for allowing short selling because they're in effect providing liquidity. So they're compensated for that. Now, in this structure, there is no direct link between a potential short seller, the short seller who is borrowing from here. They're borrowing from a broker of some sort, and then they're selling to the market, typically through a broker again. In this arrangement, when these warrants are created, they really only care about this. Who is the recorded holder? This person is still the recorded holder of the warrant. It's not like the short seller is the recorded holder. They're not. They're recorded as being on the short side of the equation. So when I look at the scenario here and this, I don't think this is accurate because it literally wouldn't make sense. Because then there would be warrants that are being generated out of nowhere. There would be an inadequate number of warrants if the warrants aren't being created based on the recorded shareholders for them. So that is my argument. Let's prove or disprove. And as you know, I am very, very willing to be wrong. I'm okay with being wrong. Okay, so I'm going to ask, let's ask AI. I'm going to first ask ChatGPT. And let's see what ChatGPT says. I need to close this little sidebar. Okay, so the question I'm asking is, in GameStop's warrant offering, does a short seller need to provide the warrant? Or is it provided by the broker automatically or other source? Doesn't necessarily matter if it's provided by the broker itself or just by some sort of entity. So let's see. A short seller does not provide warrants. When you short a common stock, your broker locates and borrows the shares. If the company like GameStop conducts a warrant offering, those warrants are issued by the company to new buyers, not to existing shareholders by default, which is incorrect. Warrants are separate securities, not automatically attached to the shares outstanding. Okay, so this absolutely could be otherwise. So let's see. So in GameStop's scenario, they are offering the warrants to existing holders and warrants for one warrant for each 10. One warrant for each 10 shares held as of a record date. Does this change? Okay, if the warrants are issued as a shareholder entitlement, then the lender of record is the one legally entitled to receive the warrants. The short seller has a delivery obligation. If you are short on the record date, your broker must ensure the lender receives the correct entitlement, which is exactly the same thing. Practically, the broker handles this. They must either deliver the actual warrants or make a cash in lieu of adjustments to the lender. The cost of the obligation is passed through to the short seller. So this is still, again, this is effectively what I'm saying, which is the broker, based on my glorious little diagram, the broker is doing this. And it's because the shorts are typically done via locates. So in this scenario, there is no requirement for a short seller to go locate the warrants to then provide them to somebody. Again, logistically, it just wouldn't make any sense. The other thing, if you think from a functional perspective, that becomes a massive risk to short sellers in general, which I know that there's no love necessarily for short sellers in the community, which I understand, but there is a purpose to short selling that isn't all destructive. A lot of it can be, to be very clear, but not all of it is. It does help with price discovery. So it would disincentivize holistically short selling, because if you're automatically on the hook to then go out into the open market and buy warrants to then provide to the broker, to then provide to whoever you borrowed from, that puts a massive, massive burden on the holder of the short shares. And then again, in order to be subject to that kind of risk, it's almost like a short seller of options who is compensated for early exercise risk. That's why we see different premiums in European style options relative compared to American style options. It's because the potential for early exercise, which matters. That is a risk for that side of the equation, which is certainly still part of this. So that's one thing that was actually sent to me that I don't think is accurate. And at least based on what we've loosely looked at together so far, it seems to be corroborated that it's not fully accurate. Again, I don't think that they're trying to do anything bad. I just don't think that they necessarily know. All right, let us continue. First, let me get caught up on the chat. Ben says for every 10 shares of GameStop, you will receive one warrant, but the warrants themselves will be tradable on their own. Yep, that's correct. So what they're saying here is they're going to list them on the New York Stock Exchange the day after the distribution date, and they're going to trade under the ticker of GMEWS. That's effectively the security type that this will be until they expire. They do have an expiration date. So the way to think about it is like this ticker that you're looking at is kind of like a single option line item that's being traded. It's just not resting in an options chain. It's been pulled out effectively. Now, another really important thing to note about this is that this isn't immediately dilutive, but it can be dilutive. Here's why. The reason why it's not immediately dilutive is because there's no additional shares out, right? This is just the ability to buy shares at 32, okay? Now, when it becomes dilutive is if people choose to exercise their warrant, then the shares have to come from somewhere. So either they come from GameStop as a company, their holding of shares, which I don't think they hold or hold much, or they're going to have to create shares in order to convert. So at that process, if they choose to convert shares or create shares to convert, that's dilutive. We're now adding more shares to the pool. But it's not inherently the case. So right now, there's nothing really dilutive here. All right. Ben, let me know if that answers your question. And then I will keep getting caught up on the chat. Reese says, either way, GME has no real risk with these. No, not really. The only risk GameStop provides with these as a company is the dilution. Like that is a risk that a company has to take on. But again, the reason why they're doing this at 32 is because they're fucking smart. If people exercise this at 32, they can make a lot of money in a raise that isn't immediately dilutive. So yeah, I think that from a leadership perspective from GameStop, I think that this is like a no love lost kind of thing. If you don't get there, and if people aren't exercising these for whatever reason, okay, cool. They choose not to exercise them. That is what it is. But if they choose to exercise them, then you are getting a pretty good price at $32, especially comparatively against what this thing currently is valued at, right? So if we valued GameStop at $32 per share, I don't know what that would put its PE ratio, but this, I think itself is it would put it at a pretty reasonable level. All right. Lauren says, I'm curious if I'll be able to get them on Webull. It's not sounding like it. Really? Well, Lauren, that's a great question, because I don't know from a settlement perspective how that will ultimately work, because you still rate them. So if you're holding shares of GameStop, I actually am not sure why a broker like Webull, because they're not like some peasant broker, they have people. So I would be really, really surprised if you wouldn't get them. What leads you to believe that you wouldn't rate the warrants through Webull? Have they put out a statement or something? Because that doesn't make any sense to me. Bull says, I think Webull does cash conversions, but that's based on a Reddit post. If you're worried, I'd text their chat or call them up. Okay, yeah, so maybe we'll take a look really quick at Webull. Because again, that I am admittedly unaware of. So what brokers will provide the warrants versus what brokers will not, and instead they will provide the cash conversion? Let's see. This is going through Perplexity. Most major U.S. brokers, Fidelity, Schwab, TD, E-Trade, Morgan Stanley, IB, Webull, Ally, First Trade, Quest Trade, Cap Trader, there's actually some in there I don't even know, will provide actual GameStop warrants to shareholders in eligible accounts, allowing holders to trade or exercise them directly. Brokers like TD Direct, which is Canada, also confirm full warrant support with no cash in lieu. Trading 212 reports newly added support for warrant trading, although exercise may not be directly offered. So in that case, they would probably, in the case of exercise, they would just give you the cash and then you would just buy it at the market price, and then you would effectively capture the difference. So same, doesn't make a difference. By contrast, brokers such as Robinhood, Wealthsimple, and Revolut generally do not support warrant distribution. Shocker. Robinhood being fucking lame. Amazing. Instead, these brokers typically liquidate the warrant or provide a cash equivalent based on the warrant's market value at distribution, which would be probably the cheapest it'll be worth. So affected shareholders receive money rather than an instrument itself. This practice is mainly due to limitations in their systems or their focus on simplified trading products. Yeah, to be honest, none of that shocks me, because there is a downside to cheaper brokers. Like this is why places like Robinhood, for example, you all know I'll always take a few minutes to shit on Robinhood. This is why places like Robinhood have such awful bills on their trades, because they provide you no commission trading, right? Like that sounds great. But again, anybody that's been around finance long enough, you know better. You know that there is no free anything. So how is Robinhood making that up on the back end? Through payment for order flow. They're bundling your orders, selling that order flow off. That process of bundling is inefficient from an execution perspective. And to be clear, Robinhood is not the worst or the only offender when it comes to payment for order flow, but they are one of the worst in total. And it's because they need to try to recoup so much cost because they're not charging any commissions. So you're just not paying on the front, you're paying on the back. So it doesn't surprise me at all to see some of those brokers that are doing that. Now, the good part is you have plenty of time to switch. There's I don't have any love lost for anybody that's at Robinhood to start, and I don't have any love lost for anybody that chooses to stay at Robinhood. So if there's anybody that's like complaining about Robinhood doing this, I'd fucking change your broker. Like, it literally is that simple. You can transfer all of your holdings. It's super simple. So yeah, no love lost for that scenario, but that's what it looks like. So it looks like, as I would anticipate, most major brokers are providing support, which is good. Ben says, is the asset being owned by October 3rd require the asset to be in the account settled then? Example T+1 would ask that we buy on October 2nd. No, I don't think so. Because typically speaking, because the way it'll also work is you'll see the price in GameStop reflect this the day after the distribution. So in this scenario, I don't think so. I don't think this settlement matters. It's kind of like a dividend capture strategy. So for those that don't know, there's an entire trading strategy built around a similar concept when it comes to dividends. I've ran it for years. And you just have to own on the ex-div date or before the ex-div date, depending on the timing of when the ex-div date is. So you can buy on the day and then sell the next day, and you rate the dividend. There's, again, entire strategies built around this. So Ben, I don't think it has to be settled, but I'll confirm it with Perplexity. Again, because I am not positive, but pretty sure. Okay, so Perplexity is saying the opposite. Perplexity is saying it needs to be settled so that ownership actually settles and recorded on the 3rd October. That actually surprises me. But let me take a look now at Gemini. Yeah, okay. So it's, I'm an idiot. I'm an absolute idiot. Yeah. So it says to be eligible for the warrant distribution, an investor must be a holder of record. I'm a fucking retard. So holder, I like completely just did not include that place in my brain. Yeah. To the record holders. Yeah. So it does need to be settled for sure. My bad. Sorry, guys. This is why we check. We are fallible. I was completely wrong with what I was saying before, because ex-div dates like this, they typically will take that into account. But yeah, this different story. So yeah. So in this case, Ben, you're exactly correct. You would need to buy on 2nd October in order to rate the warrant. That's exactly correct. All right. Coffee says DTCC screwed over GME and retail with the 4-to-1 dividend. I was wondering what nefarious things they are cooking up for the warrant dividend. I don't totally follow. Yeah, I don't totally follow that. Paul says there's so many naked shorts, this will create the largest squeeze in history. I mean, a man can dream. I'd never take your dreams away. I personally don't see any mechanism in here that would drive a squeeze. I also genuinely, I'm not as big of a believer in like this theory that there's just an overwhelming number of shorts right now that are, stuck. Not saying it's not the case. I don't know. And I can't prove it either way. Nobody can, because we can't see the holding positions. And this isn't to try to put down the idea. It could be accurate. It could be fully accurate. But just thinking through this logically, with the number of offerings that have occurred, there's definitely quite a lot of liquidity available to find shares. So I absolutely believe that there was a period, especially when most of the shares in GameStop were locked up, that there was probably lots of people stuck on the wrong side on naked shorts, not wanting to go try to locate. That absolutely, I think that holds a lot of potential merit. Still can't confirm that it is objectively the case, but feel pretty confident that, again, that holds a lot of merit. But with the offerings and whatnot, I don't think that logically that holds as well anymore. And the issue with that is, let me see. I want to see what the current short interest is. Let's see. Or let's not see. That's also a choice, I suppose. All right. Let's see. So short interest is 66 million. 5 days to cover. That's actually pretty high. I'm not even gonna lie. That's actually pretty high. That's still higher than I would have expected. Float is not significant. 16% is not significant at all, but that's a little eye-opening. I'm now very curious. What does this say? 4 days, even that's a long time. So that in and of itself is super squirrely to me. That's so squirrely to me. This is why this always with GameStop. Like every time I look at GameStop, there's all these fucking anomalies that don't make sense. So the thing that doesn't make sense is if there's only 66 million shares short, which represents less than 20% of the float, why would it take 4 to 5 days to cover? That doesn't make sense. That's not normal. Normally, if it's this low, it would not take that long to cover, especially because of how many shares are available. So that's super interesting, and that's anomalous. That's not fucking normal. That absolutely is not normal. Weird. Super, super weird. This is the other thing that we need to take a look at. So this will give us some context on how the overall options market will behave. So this is from OCC, Options Clearing Corp. And so each warrant will provide the right to purchase one GameStop Class A common at 32. So we have the record date, expiration, the agent is computer shares per normal. All right, contract adjustment. Option symbol, GME becomes GME1. So divisors 1, multipliers 1, new multipliers 100. So the new deliverable is 100 shares and then 10 warrants. Okay. The GME component of the GME1 exercise assignment activity will settle through National Securities Clearing Corporation. OCC delay settlement of GME warrants component of GME1 exercise assignment activity until the trading status of the warrants is determined, okay? Upon determination of the trading status, OCC will require put exercisers and call assignees to deliver the appropriate number of warrants. Yep, that makes sense. It is not yet known if the warrants will cease trading on NYSE prior to the expiration. The warrants are expected to expire on 30 Oct. GMEWS component of adjusted option GME1 will remain part of the GME1 deliverable until the warrants have expired. Once expiration of the warrants has been confirmed, the GMEWS will be removed from the GME1 deliverable. The change to deliverables is expected to be effective on 2 November 26. So the pricing of GME1 will be GME plus 10 cents with times the warrant, okay? When the warrants expire, adjusted GME1 options will further adjust it to no longer call for the delivery of the warrants. No adjustments will be made to the adjusted contracts to compensate for any in the money value of the GME warrants may have at the time expiration. The warrants are to be suspended from trading before the opening on a date to be determined and expire 30 Oct 26. Call option holders who wish to exercise their adjusted options to attain warrants for the subsequent exercise, sale, or other purposes bear sole responsibility for determining when to exercise their options, as well as comply with all terms and conditions of essentially the overall deal. Yeah. So this is like pretty standard, realistically. Uncovered short obligations. Holder of assigned calls or exercise puts in holders of short positions in physically settled security futures at maturity who do not possess the underlying security at the time of assignment or exercise are subject to special risk. This has always been the case. Same. Suspension of trading of the underlying security and ability to borrow or similar events may preclude the possibility of affecting timely delivery, thereby exposing persons with obligation to deliver to a liability if timely delivery is not affected. Bam. So yeah, this is all pretty standard. So they're essentially going to adjust the options for him. Cool. That's easy enough. Let's see if there's anything else that we can dig up at a high level. And if there's any stories about the warrants that I haven't hit yet that you want to talk about, please let me know. And we have plenty of time to poke through. It's not quite dinner time yet, although it is getting close to dinner time. We have a little time. Don't worry, Thor has had his dinner and he's living his best life. One of the funny things he does is when he's laying in bed, he like droops half of his body off the berm of the bed, which really just doesn't look comfortable at all. It kind of reminds me of like having a lump under part of your body. Don't know why he does it, but I support him. It's completely cool why he does it. All right, let's see what Yahoo says. Special dividends in warrants. 10 shares, 1 warrant for every 10 shares in lieu of adjustment to the applicable conversion. Holders of the senior notes due 30 and 32 will receive warrants on an as converted to common stock basis. Company expects to distribute approximately 59 million warrants 7 October. They will be issued without any action required by the shareholders or note holders. Okay. We know the exercise price is 32. Holders can only exercise a warrant by paying the exercise price to acquire the shares of common stock in cash. Following distribution date, warrants are expected to be freely tradable and listed on the NYSE under GMEWS. Recipients of the warrants will be able to trade their warrants or exercise any in accordance with the agreement, irrespective of whether they continue to hold shares of common or convertible notes, kind of just like a dividend, where if you hold through X dividend date, you rate the dividend, whether you hold the shares of the underlying when the dividend is paid or not. So effectively the same. Transaction provides GameStop shareholders the option to participate in a capital raising on a non-dilutive basis. I'm curious about this non-dilutive basis, though. How is it non-dilutive? If exercised, the warrants are expected to generate up to approximately $1.9 billion of gross proceeds. I mean, that would be dilutive. I don't understand that. Let's run this through, because I am curious on that. If the warrants are exercised, would that be dilutive? Question mark. Yes. If the GameStop warrants are exercised, it will be dilutive to existing shareholders. Yeah, okay. So maybe they're saying that it's non-dilutive right now, because that is facts. And that's kind of what I was differentiating from earlier. Is so I mean, maybe that's the way that they're framing it. The only thing is, like, I don't agree with framing it like capital raising on a non-dilutive basis, because to me, that honestly is just inaccurate. If they raise any capital from these warrants, then it will be dilutive. So these two are kind of inexplicably tied to one another. So it's non-dilutive right now, but as we were talking about before, if they are exercised, it absolutely becomes dilutive because you have to provide the shares from somewhere. So yeah, I just think that's a little bit misleading. All right. Haggis says, how do we find out who loaned GameStop or GME the money without interest, the other dilution? I don't understand your question. How do we find out who loaned GME the money without interest, the other dilution? Don't follow. Sorry. Jason says, is it non-dilutive because it's at a price higher than what we're currently at? No, it's a good guess, but no. I literally just think that this is an inaccurate statement. This is incorrect. Because again, as soon as there's any capital raising from here, then it's dilutive. It's just non-dilutive right now. So yeah. Haggis says, what if you have covered calls during warrant week? It's a great question, actually, because it is a great example of early exercise potential. So there is a higher risk of early exercise for covered call holders, or sellers, I should say, during that week. Just like any other early exercise potential if a dividend is coming up. We can use that really quick because that'll be a slightly easier example. So what I'll do is I'll try to find something that has an ex-dividend date coming up. So I'm going to ask Grok, help me find a list of stocks that have an ex-dividend date coming up within the next, let's call it 20 days, that have options. Let's see. Michael Solar says, what about if it doesn't hit 32 by October? They would just expire worthless. So just like a call option, the way to think about these is that they will look a whole lot, like if you're curious, they're going to look a whole lot like these. Like this right here. Except they're going to be further out. Because what did we say? It was in 2026, October. So they're going to look more like this. Here. Like that. Now it's obviously different ratios in terms of value, but the fundamentals will effectively look something like this. So if it doesn't even necessarily matter if GameStop doesn't hit 32 at or beyond, my guess is for the majority of people that get the warrants, just like options, the majority of them are going to trade them. Right? Because, for example, let's just run a thought exercise. Eric, I hold shares of GameStop. You all know that is part of a covered strangle. So in this scenario, if I get the warrants for $32, and in my mind, I think GameStop is going to hit or go above $32. Why would I wait to buy shares at $32 versus buy them now at $24.93? I will make way more money. Same thing if I buy them at 25, 26, 27, 28, 29, 30, 31. I'll make more money in all of those scenarios as compared to waiting. You're not getting any sort of like big discount by buying at 32. Moreover, you actually can't buy as much, right? So let's just talk about the concept of units, which in this context, units are super, super important. Actually, probably better just to use Google Sheet. I think it would be a little easier for you guys. Let's grab that bad boy. And give me 1 sec. I got to grab the door. All right. So let's talk about units. So let's say GameStop is at $25 now. And then let's say it's at $32 at some point in the future. So let's say I wanted to buy 100 shares in both scenario. What does this cost me? So here's the economics of that. Again, in the context of somebody who thinks GameStop is going to go to 32 or higher. If I fall into that bucket, I can get way more shares and way more value if I buy now at 25 versus if I wait to use the warrant and buy at 32. I actually am $700 cheaper, 28% cheaper if I simply buy the position I want now versus waiting until then. Commensurately, if I wanted to actually buy the same dollar value, I would actually get 128 shares today than what I would get if I waited to get it at 32 for the same cost. So this is why in this kind of scenario, most people are probably going to trade it. That's exactly what I'm going to do with the warrants. I'm not going to trade them right away. I'll see how they trade, what the liquidity looks like, all that kind of stuff. But there is really not a scenario where I'm going to prefer to exercise the warrant and buy at 32 versus buying at spot. Because even in the scenario, let's say that I'm saving money. Let's say that I don't have a bunch of money and I'm a normal working person and I have a certain amount of money that I save each week and I buy shares of GameStop with that. Great. I still am going to be better off taking whatever that dollar amount is and just consistently buying with GameStop where it is now versus, again, waiting until I have a bucket sum of money to be able to buy 100 shares at 32. You still have to pay for them. They're not free. So yeah, in general, most of us, we're just going to trade them just because it doesn't, just like options, it's generally less efficient in exercising these versus just trading them. Rutabaga says, what's the point of the warrants if the company doesn't think their shares are going to go to 32? I imagine the company probably does think that the shares will go to 32 at some point, but more importantly than that, it's zero risk. So for example, if let's say somebody does choose to exercise them early just because they want to play with the button, see how it works, they've now raised money at a premium. Let's say that nobody chooses to exercise at all and they all expire worthless. That doesn't cost GameStop anything. So it's super low risk. But what it does do is give people the ability to buy at a discount if GameStop does rally over that time frame and if it's above 32. But it's not really an indication, in my opinion, of where GameStop thinks the price is going to be necessarily. It's just honestly, it's a really slick way to put a no-risk trade on, because that's effectively what it is. It's a no-risk trade for GameStop. They have no risk out in it. So Jason says, wouldn't them putting out these warrants force naked short sellers to have to provide warrants? No. So we already talked about that much earlier on in the stream, but the Cliff Notes version of that is the short sellers aren't part of that transaction. The brokers are the ones who will provide the warrants. That's how. TCM says, will they have extrinsic value? For sure. Definitely. Just like a call option. They will absolutely have extrinsic value, because think of it this way. Do I think of, let's take a look at two scenarios. We got to find a, Jesus Christ, this is a lot of shit. Let's take a look at two scenarios. Today's 13 Sep 25. And then we're going out to Oct, 26? And then let's say that there's one in June. So if there's two scenarios where the warrant covers this span versus this span, let's just say ceteris paribus, everywhere else, everything else is the same. So let's just say that the stock is at 32 specifically. Let's just say it hits 32. In this scenario, this warrant is worth way more than this one. Why? Because it has a much longer runway for the stock, hopefully, to go up higher and higher and higher versus this one. That's extrinsic value. So yeah, definitely will have extrinsic value of some degree, for sure. Michael says, how can the warrants trade before it hits 32? Just like a call option. Just like these. Right now, these 18 June 26, 32 calls, they have 2,420 open interest. And then if we go out further to 15 Jan 27, we go to the 32s. There's 681 there, but then there's 48,000 at the 35s. As you guys remember from the other streams, those round numbers tend to have more. I'm just using it to give you a proxy of how these things are trading, even though the underlying isn't there yet. The reason why they trade before that is this. Let's say, again, today, 13 SEP, GameStop is at 25. And there's a warrant at the 32 strike, essentially. So we'll just call it 32 strike. Let's just say today that this is worth $1. Now, let's say that GameStop 7 days later, 20 SEP, goes to 30. The warrant, even though it's not at 32 yet, but now that same 32 warrant is going to trade for more money. So let's say now it's at $1.50. Why did this happen? Because now there's a much higher probability that it's going to go above or much higher than 32 than where it was here. So you're essentially trading the ability to trade around a future value. So that's why these warrants will provide some sort of price. Now, they will probably trade pretty cheap, but they're fairly long duration. So that will absolutely be worth something, because the scenario here is for shareholders, it is a cheap way to ARB. So the way that that ARB could work is if you just hold, you do nothing. You get your warrants. So let's say you have 100 warrants. Not for your rest, but to buy the shares. And let's say that we fast forward time, we start 13 SEP, and we're at 25. The holder can choose to do absolutely nothing. Completely cool. Then let's say we now go to October of 25, and now let's say GameStop is at 24. Again, no risk to the warrant holder. They still have their same position. None of this matters. We just hold on. So let's say now a better scenario happens. Let's go to June of 26. Let's say GameStop has a squeeze. Let's say GameStop has anything. Let's say GameStop has a squeeze and goes to 50. So for the holder of the warrants, let's say that the beginning of your position, the beginning of your idea, the beginning of your trade was just to hold your shares. You weren't looking to add more. You just wanted to hold your shares. But let's say that GameStop does go to 50. Now you have a pretty easy choice. You can do one of two things. What most of us would do is sell to close the warrants. Another choice is to exercise and then sell to close the shares. Either or. So the cool part about the warrants for people that hold them is if you're holding the position that you want anyways, again, there's just upside potential. It doesn't hurt you literally at all from the holder side of the equation, which is, again, just really useful. That's why it's such a low risk thing for pretty much anybody. Yeah. Pyro says it's non-dilutive for shareholders because they get more. It's dilutive if they sell the warrants. No, that's incorrect. It's completely incorrect. The reason why, again, that's incorrect is the shares have to come from somewhere. And the warrants are essentially deals between you, the holder, and GameStop. It's not the deal between you and the broker. Nothing like that. This is a deal between you, the person, and the company, GameStop. So then if you choose to exercise, just because you want to, which is cool, you choose to exercise. If you do that, GameStop is now going to say, I now need more shares. So let's say that somebody exercises 10 shares worth of warrants. You exercise your 10 shares. They're going to create these 10 shares. And then they're going to give them to you at 32. That's how they raise money. Anytime you see a capital raising exercise like this, it has to come from somewhere. And that's why you'll notice that they're referring to it as a capital raise. So what are they doing? They're creating shares to sell them. They don't raise capital if shares aren't created in this scenario. That's the way that they actually raise money, which again, it's not inherently a good thing, bad thing. The thing that makes that kind of stuff slightly suboptimal is the stuff, like what makes that suboptimal is literally just the fact that in the long term, for people that hold the stock that you hold becomes slightly less valuable because there's more of it. That's dilution. The main downside for those that really are hoping for squeezes, that's also problematic because now there's higher liquidity in the underlying, which naturally decreases the propensity for a squeeze. So yeah, it's really generally beneficial for the holders in the company longer term, but yeah. Rutabaga says, do warrants have to be hedged by brokers like options? So the first thing to be super clear is brokers aren't the people that are hedging anyways. You actually mean market makers. So here we have a broker. Here we have a trader. Here we have a market maker. So the way that this works is the trader is just doing business through the broker, but the other side of their trade is actually the market maker. So you say that I want to buy a call. The market maker is the one who says, okay, I'll sell it. Now, the way that the market maker ends up profiting longer term is they capture the bid-ask spread among other activities. So they're not really necessarily trying to trade against your position directionally. So in order to not trade against your position directionally, they're going to hedge this position so that they're really focusing on the risk that they want. So they will hedge. In the scenario of including the broker, they have nothing to do with any of this. The broker's just completely out of the equation. They're not holding the positions. Now, to be clear, there are some brokers who will internalize trades and effectively market make in-house, but that's way more the exception than the rule. Very, very infrequently you see that. The majority of the case, you'll see it like this. Now, with the warrants, the thing about the warrants is, again, think about the scenario here. The scenario with the warrant is they aren't on the other side of your trade here. It's now a company called GameStop. So there is no risk that GameStop has. Either one of two scenarios come up for GameStop. They're either going to sell you shares at 32 via creation or nothing. So there's nothing that they have to worry about with respect to risk. They're not managing inventory like a market maker is. It's a good question. Pyro says, if you're a holder and you exercise your warrants, your holding increases at the same percent of float, non-dilutive. No, that's not true. It's literally not true. The reason why it's not true is if we have 100 shares here, let's say that this is the market, right? This is the float. And let's say your 100 shares are worth $1. And then anybody chooses to exercise a warrant that gives them 1 share. So now the float is 101. This is not worth $1 anymore. Maybe now it's worth 90 cents. That's dilutive. Unequivocally dilutive. It's specifically, the concept of dilution applies to current shareholders. If you're a new holder, you're indifferent. It doesn't matter to you. You don't have a position that can be diluted. But when we're talking about dilution, it's with respect to the existing shares, not new shares. So if you are a holder and you exercise, it absolutely is dilutive. Because if you're a holder, let's say in this scenario, this person held 5 shares. And again, your 5 shares are worth $1. Even though you now have 6 shares, let's say, because that extra share was you, those 5 shares went from $1 to 90 cents. And then your 6th share is at par value, whatever the existing value is. This share doesn't care. This share is same with whatever the concurrent value is. So this would be, again, 90 cents, say. This one doesn't care. These 5 do care. It absolutely is dilutive. Jason says, I'm still confused about it. If there's a bunch of people out there that bought shares that were sold naked, those people still need to get their warrants, right? How does that work? If there's a bunch of people bought shares that were sold naked, those people still need to get their warrants, right? Yeah, definitely. So that kind of scenario, if we're going through the scenario of naked shorting, then there still has to be a source route for recorded holders. So the recorded holders will be taken care of regardless whether it's through cash in lieu of shares, which is very likely in a scenario like that, specifically for the naked shorts, if there is a pairing with those, or via the shares if they are a recorded holder, either or. Pyro says, okay, but if you had 100 shares, you have 110. Yeah, you have more shares. That doesn't matter. The value of your existing shares went down. That's what dilution is. It's not the accumulation of more shares. Completely different concept. You having 110 or 120 or one whatever versus what you had before it literally doesn't matter at all. When we're talking about dilution, the thing that we care about is what was the value of my holding before the dilutive event, and then what is the value of my holding after the dilutive event. That's what creates dilution. So even though in the example I gave you, that person went from 5 to 6 shares and their 6th share was not diluted because it's new, it doesn't have any existing value because you don't have it yet. Your 5 shares in that scenario most certainly were diluted because of the creation of the 6th, for sure. Rutabaga says, don't forget that you're paying for those shares when you exercise and GameStop raises that capital. Definitely. Yeah, I imagine most people caught that when we were talking about it before. Because to reiterate that point, it's not like the shares aren't free. Pyro says, okay, you're saying because you had to pay to exercise. Definitely. Yeah. I'm not sure where you jumped in the stream, but like we were talking about before, if you have the 32 warrant and you exercise, this you don't just get shares at 32. You have to buy to open shares at 32. This is how GameStop is raising money, is because you are buying shares from them and they are providing the shares to you. And it doesn't cost them anything to provide those shares. Yeah. Pyro says, I just wasn't putting it, I know you have to pay to exercise. I just wasn't putting it into the dilutive maths. I'm just trying to impute how they say it's non-dilutive. The reason why they say it's non-dilutive, and if you caught the beginning of the stream, the reason why I also said it's non-dilutive right now is because this hasn't happened. This hasn't happened at all. So what it does is it gives a scenario that can be dilutive if the holders choose to exercise and GameStop chooses obviously to settle via creation. That's how it's non-dilutive. There's another scenario that can be non-dilutive. But I haven't seen anything yet that leads me to believe that they're going to do this, because it's not part of the playbook I've seen from them so far. But this is what they could do. They could say, right now, today, so again, 13 SEP, we estimate XX warrant exercises. Because they'll have a pretty good idea of what they think their stock will be worth over that time frame. They can estimate this number. It won't be perfect, but they can estimate. Then what they could do is they can slowly start buy open shares on the open marketplace. There's still plenty of shares available. They can buy to open shares from the marketplace. So then that would have them buying shares from 25 to 30, let's say. If they did this, then it is non-dilutive, which is actually very cool. I don't think they'll do this. But if they did this, it's very much non-dilutive. The difference, though, is that the way that they're now raising money is literally through capital gains. Because in this case, if you choose to exercise at 32, they're not creating new shares to sell them to you at 32. They're taking whatever they have from what they've bought, and then they're selling that to you at 32. So the other difference here is they don't make anywhere near as much money, because where they make the most money is, let's say they create 100 at 32, they make $3,200. In this scenario, let's say that they bought to open at 32, at 30, and then they sell to close to you, settling their account at 32. That means that they've made $2. Let's say it's 100 shares. They have $200. So that's a completely different amount of capital in this scenario. This is why my estimation is absolutely going to prefer creation, because that's how they're going to make the money. That's how they're going to raise the capital for whatever it is that they want to do. Jason says the good news is that it seems like it will result in a cost for naked short sellers one way or the other. Not really, to be honest. Yeah, not really. There isn't. I actually don't see where there would be some sort of direct cost to the naked short sellers. Yeah, I don't see that here. Pyro says they estimate to raise 1.9 billion, so it's not the scenario. Now, just to be clear, they don't estimate to raise 1.9 billion. What they're saying is they can raise up to 1.9 billion. Very, 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 very different scenario. Because if exercised, the warrants are expected to generate approximately 1.9 billion. Nobody is expecting the warrants, meaning all of the warrants, to be exercised. That just isn't going to happen. So, yeah. In this case, they're just saying what the total value would be if the warrants were exercised, but they're not going to be. My guess is it'll be actually quite a smaller amount exercised overall, just leading on what it tends to look like. Jason says that I'm confused. You said that they will have to settle with cash if they aren't providing warrants. Yeah, you were talking about the naked short sellers. Yeah, in that specific bucket, for sure. Again, it's important to be specific with our language, because before I'm sorry, because there's two big different buckets here. And there is a reality that some of those naked short sellers aren't going to have to pay cash in order to settle those. Definitely, I imagine that will be the case for some of them, depending on the arrangements that they're built through. But in the premise of those who are naked short sellers in this scenario, most of those are going to be through an entity like market making, and they're still going to be liable to essentially produce a certain number of shares anyways, or a certain number of warrants for the shares that they hold. So there's really two different ways that it can go. It's not inherently going to be a direct cost to naked short sellers. It could be in some circumstances. And to your broader point, anyways, to agree with your general sentiment is that it definitely doesn't help them in any way. There's nothing in this that's going to be like a direct help unless you see a ton of things exercised. Again, the concept of naked short selling is to try to sell and make more money by not holding or providing the collateral. Now, there was a period for a long time in GameStop where part of that was also complemented by the fact that you couldn't even find the underlying. You were literally restricted in what you could buy because the float was generally locked up, which was awesome. But with the float not being locked up anymore, it's actually quite easy for naked short sellers to ebb and flow between being naked when they want to, coming out of being naked to cover, and then back and forth because there's an abundance of shares. We're in a slightly different scenario. So to summarize all of that, a naked short seller could incur a cost, but it's not direct that they will. And in a lot of instances, they might, depending on how their short arrangement is set up. But in equal instances, again, it's hard to tell because we don't even know how many naked shorts there are at this point. But there's also the just tracking and still provision of the warrants themselves. So yeah. Hey, yo, shout out to Lauren. Lauren just hooked 5 people up on the channel. Thank you for doing that, Lauren. Super nice of you. Anything else? Okay, so H says, I don't care about the naked shorting narrative. It seems like there's been enough time and opportunity for any that existed from the squeeze of 21 to close. I don't know, though. I agree with you. I absolutely agree with you. The reason why I agree with you is because the concept of being stuck is the float not being accessible and not being able to locate shares, but that's really not the case anymore. So I think broadly I agree with you. Make no mistake says if GameStop is trading at 50 in October of 26, surely all warrants will be exercised. No, not at all. The reason is this scenario we were looking at before. So let's say you have the equivalent of a 32 strike warrant. And you have really two choices. You can either sell to close, or you can exercise buy to open shares. So if GameStop is at 50, what's going to happen is the value of the warrants is going to go up significantly. So let's say, again, 13 SEP, let's say the value of your warrant is $1 with the stock at 25. And let's say that the stock doubles and it goes to 50. We'll just, for ease, say that the warrant is now worth $2. So what will happen is the holders of those warrants will make a choice. They'll either say, yes, I want to take on the inventory and hold shares and buy them at 32. Or, and again, remember, that's going to cost $3,200 to get 100 of them, 100 shares. Or they can just sell to close the warrant. And they net the difference between these. So they net $1. They make that $1 for literally nothing. It's just free. It literally is the example of free money because they held the shares. So yeah, no, it doesn't mean that. It doesn't mean in this instance. And again, my expectation is that the majority won't be exercised. Again, it's the same reason why the majority of options are not exercised. It's just generally an inefficient transaction. Pyro says, who are they selling to close to? At the final moments, somebody has it and won't be able to sell it and will exercise. No, not necessarily, because again, it might not make sense to exercise. Now, if we're going in this scenario where somebody is in the money, maybe some of them will, but not necessarily, because there also could be people that have shares, let's say that you're holding it, because again, remember, there isn't a delivery mechanism. They go away. They become worthless. So in that scenario, you can even find, Pyro says they'll just expire. Yeah, exactly. Some people absolutely might let it expire if they don't go this route. Because let's say, for example, again, you're a smaller GameStop trader, that kind of thing. And in their accounts, they literally might not have the money to exercise them. They might literally not have the $3,200. So even though it was worth something, they hold it into expiration and it's not worth anything. That absolutely can happen. And I imagine in some not insignificant number of cases that definitely will happen. But in the majority of instances, what will happen is the people will, again, sell the warrants. And depending on who the counterparties are to them, if the market makers do start getting involved, they'll just maintain their inventory. They'll want it to expire worthless because they'll arbitrage away the extrinsic value. They'll collect that. So yeah, my guess is a whole lot of these won't be exercised in general. TCM says, so do all existing options convert to GME1 with the warrant component built in? Yeah, we reviewed the paper from OCC earlier that summarized all of it, but that's effectively the case in the duration where the warrants are applicable. Because remember that the warrants, they're not going to be provided into perpetuity. There's a holding duration, which, what is it, like October of next month? So they'll be adjusted for that. Rutabaga says, so basically GameStop wrote a bunch of call options and gave them away as dividends. Yeah, I think that's a pretty fair way to look at it. The only difference is when it comes to a dividend, typically a dividend is paid from the proceeds of the company. In this case, the dividend, quote unquote, special dividend would be paid via creation. So yeah. In the scenario for this, like I said, everybody will have to figure out what the right decision is for you. And that's always what matters the most. But for most people, it will be more efficient to just trade the contract, provided that it's liquid. That's another scenario that we didn't talk about here because we haven't seen it yet. The reason is because we don't know exactly what the market will look like for them. But there absolutely could be the scenario where the market is just super illiquid and there is no liquidity provision there. And if that's the case, you're just not going to see it trade much at all. And then the scenario of people trying to trade it might not come to fruition. It might become a liquidity issue. So we'll have to see. Bull says, is there a way to know how many of the warrants are exercised day to day? Yeah, you could actually just track the number of shares that are outstanding. Because again, as they're exercised as against GameStop. So in that scenario, you'll see the total number of shares up here change. Now, I don't know what the reporting basis is going to be, meaning how frequently they would update the metric here, that I don't know. But they will update the metric here with the total shares outstanding. So that will change as people choose to exercise, because again, it's creation that will be occurring. H says, where do you get that number from? You mean the number of shares outstanding? You can just Google it. Like, this is in Thinkorswim, the platform, but you can get it pretty much anywhere. It's also based, it'll always be on whoever lists GameStop. So Yahoo Finance literally has a chart that provides shares outstanding. And then where is... let's do here. You can get it directly from NASDAQ. This is typically a good place to get what you can, just because it's, directly from the horse's mouth. Yeah. Make no mistake says options OI can disappear as people trade out of their positions with the market makers. Warrants do not disappear. If there are 59 million warrants, if you sell them, somebody else will own it. Meaning they will have the right to exercise. And if GameStop is above 50, then they will 100% exercise. Again, it's absolutely not 100%. But yes, there definitely would be an incentive in a scenario like that to exercise. But again, it really depends on the way that the broad market is made for it. Because when you're talking about open interest disappearing, that's specifically when a buyer and seller essentially net out with one another. But a lot of time when it comes to an option, there isn't that match. More often than not, with an option, a market maker is on the other side of your trade, holding your position into expiration, the other side of your position. So yeah, that's how they make their money. And then they play the bid-ask spread because, again, it's a riskless position for them. So yeah, we'll have to wait and see, because a big part for all of this will definitely be how liquid the market is, because the market in the beginning is not going to be liquid at all. It's going to be awful. I'm actually super curious, because the thing to remember is that there will be a lot of entities that will hold these warrants that are also at the corporate and institutional level. So yeah, super curious to see how the liquidity plays out. So I am actually really interested specifically to see when they start trading, because that'll be a dominant factor in this scenario where we're talking about the decisions between exercising or selling to close. Because if they're super illiquid, you're also naturally pushed towards exercising. Because even though it's a less efficient transaction, if the market isn't liquid enough, it's still more efficient than trading in an illiquid market. So that'll be a highly dominant input into the decision making for anybody. Really can't say what game theory too much of it yet until we actually see that and see how the market holds up. So we will soon find out. That is for sure. I think it'll be pretty fun. The cool part is, for pretty much everybody that holds GameStop, this is pretty neat in that no love lost, right? Like there's no risk to what you're doing. So you have the ability to just essentially play along, see how they do, hopefully make really good decisions for yourself, make some money on them, but you're not assuming any more risk, which is pretty nice. Very infrequent where that scenario is. So that wraps me up. Time to grab some dinner. You all know where to find me. Be an outlier. See y'all later.